Smartest Data, Warren William, quick definitions, index futures. So how do index futures work? And what are the main two scenarios to use index futures? Let's go to the video, define and explain index futures. There will be a calculation, and at the end of the video there'll be 3 bullet points to take away. Stock index futures are based on equity indexes and are exchange traded. A buyer and seller for each index, a ticker code, a contract size, a minimum tick fluctuation, and a dollar value of 1 tick. Index futures can be used to either hedge or gain market exposure. Index stock futures are exchange traded futures contracts that are based on a specific stock index. Index futures are exchange traded contracts. The futures exchange, the CME in Chicago, takes on the counterparty risk. Before futures trading can commence, an initial margin and a maintenance margin will be calculated, and the trader must fund the margin account. A trader in futures could be doing so for one of two objectives, either to manage equity market risk, thus shorting futures, or taking an index long position in futures to gain market exposure. While index stock futures vary depending on the underlying index, as they are exchange traded contracts, they are standardized in terms of contract size and expiration. The contracts are cash settled on a daily basis, and most have quarterly expiration dates for March, June, September and December. As futures contracts are exchange traded, they have a ticker code, and they are standardized contracts to facilitate trading. An example of a code for a futures contract, the CME trades the E-mini S&P 500 contract. If the code is ESU22, this signifies the E-mini S&P 500 September contract. If you want to trade the December 2022 contract, the futures code would be ESZ22. Thus the contract EN equals the E-mini S&P 500, the month U equals September, December equals Z, the year 22 equals 2022. Each futures contract will have standard conditions including contract size, minimum tick fluctuation, the dollar value of 1 tick. Then comparing two index futures contracts, the micro E-mini S&P and the micro E-mini NASDAQ 100, let's take a quick look. So comparing the micro E-mini S&P 500 and the micro E-mini NASDAQ 100, the contract size $5 times the S&P 500 index, while for the micro E-mini NASDAQ 100, it is $2 times the NASDAQ 100 index. The minimum tick outright 0.25 index points for both contracts. The value of 1 tick, $1.25 per contract for the micro E-mini S&P 500, and 50 cents per contract for the micro E-mini NASDAQ 100. The code for September for the micro E-mini S&P 500 is MSU22, for the micro E-mini NASDAQ 100 MNQU22. For each futures contract there is a buyer and a seller. As mentioned, there are two main objectives in using futures contracts: to manage equity market risk, thus selling or shorting futures, or taking an index long position in futures to gain market exposure. A quick example of hedging risk, a portfolio of US stocks, portfolio value $2.5 million. So the investor has continued concerns over the level of inflation, interest rates continuing to rise, and the risk of a possible recession. The S&P 500 is currently trading at 3,825 index points. The investor will use the micro E-mini S&P 500 using the September futures contract, thus the ticker is MESU22. First, the hedge ratio needs to be calculated. Simply put, the hedge ratio is the number of MESU22 contracts that need to be sold. The hedge ratio equals the portfolio value divided by the notional value, which equals the number of contracts that need to be sold. The hedge ratio is 2.5 billion divided by $5 times the current index level of 3,825. This comes to a figure of 19,125. Thus, the 2.5 million is divided by the 19,125, which equals 131 contracts that need to be sold. The S&P 500 falls by a further 10%, reaching 3,442 and the investor decides to close the position by buying the 131 MESU 22 contracts. Therefore, the profit would be 3,825, the original index starting position, 3,442, the closing position, equals 383 index point. Each index point equals $5. Per contract, 383 times $5 equals 1,915, then multiplied by the 131 contracts covered or bought. The profit would be 131 times 1,915 equals $250,865. Three takeaway bullet points regarding index futures. Based on an equity market index, for example, the S&P 500, they're exchange-traded contracts on the futures exchange, thus they're very standardized contracts. Index futures are used to either manage risk or gain market exposure. Selling index futures will reduce market exposure, buying an index future will gain market exposure.